3 years ago, a single $1,000 investment in Nvidia would have grown to more than $10,000 today. And the same story played out, to different degrees, across almost every company connected to artificial intelligence. So now you're here. You've heard the hype, you want a piece of it, but you also don't want to be the person who buys at the top and watches it all crash. In the next 15 minutes, I'm going to walk you through exactly how to invest in AI stocks as a beginner, the companies that matter, the different ways to get exposure, the real risks nobody talks about, and a simple framework for actually doing this without losing sleep. Let's start by completely changing how you think about AI stocks. Most beginner videos will tell you AI investing is about chips and software. Nvidia at the bottom, ChatGPT style apps at the top. That's not wrong, but it misses something important. And to explain why, I need to introduce you to a guy named Leopold Aschenbrenner. In June 2024, Aschenbrenner, a former OpenAI researcher, published a 165-page essay called Situational Awareness. The core argument was that AI progress is going to keep scaling faster than most people expect, and the binding constraint on the whole industry isn't going to be smart engineers or even better algorithms. It's going to be electricity. He then turned that essay into an investment fund. By Q1 of 2026, that fund, Situational Awareness LP, had grown to about $13.7 billion, and the way Aschenbrenner constructs his portfolio shows you the real shape of the AI stack, the one that actually moves money. So let's redraw the stack from the bottom up. Layer 1, electricity generation. This is the foundation. AI data centers consume staggering amounts of power. A single large training cluster can pull more electricity than an entire city. By the end of this decade, US electricity production is expected to grow by tens of percent, most of that driven by AI. Companies in this layer include power utilities like Vistra and Constellation Energy, natural gas producers like EQT, nuclear operators, and companies like Bloom Energy that make solid oxide fuel cells to power data centers on site, bypassing the strained grid entirely. Bloom's stock went up 176% in a few months once the market caught on. Layer 2, the physical build-out, data centers, cooling, real estate. Once you have power, you need somewhere to put the machines. Data center REITs like Equinix and Digital Realty, cooling specialists like Vertiv Holdings, construction and electrical infrastructure firms. This layer is unglamorous but absolutely necessary. Layer 3, compute hardware, the chips. Now we get to Nvidia, AMD, Broadcom, TSMC. This is where the famous names live. But notice, they're layer 3, not layer 1. They can only sell as many chips as the power grid can support running. Layer 4, networking, memory, and storage. When you connect tens of thousands of GPUs together, you need extreme speed networking and massive high bandwidth memory. Companies like Arista Networks for switching, Lumentum for optical components, SanDisk and Micron for memory. This layer is critical and often overlooked. Layer 5, cloud platforms and AI compute providers. Microsoft Azure, Amazon AWS, Google Cloud, the hyperscalers, plus newer specialized players like CoreWeave that rent out GPU compute by the hour, and former Bitcoin miners like Core Scientific and IREN that have pivoted to AI workloads. Layer 6, models and applications. OpenAI, Anthropic, Google Gemini, plus everything you actually use, Microsoft Copilot, AI features in ad platforms, AI-powered design tools. Here's the punchline. Aschenbrenner's bet, and a lot of sharp institutional money is now copying it, is that the most concentrated returns over the next few years come from the bottom 3 layers, not the top. The application layer hasn't figured out how to monetize AI at the scale of the spending. The chip layer is already priced for perfection, but power and physical infrastructure, they're the real bottleneck, and the market took time to wake up to it. So when someone says, I'm investing in AI, the smart follow-up question isn't just which company, it's which layer, because each layer has very different risk, reward, and valuation profiles. Let's go through the major players, organized by the stack we just built. I'm not telling you to buy any of these. I'm telling you who they are so the rest of the video makes sense. Starting at the bottom, Layer 1, Electricity. Vistra Corp and Constellation Energy are two of the largest independent power producers in the US. Constellation operates the largest fleet of nuclear power plants in the country and signed a deal with Microsoft to restart 3 Mile Island specifically to power AI. Both stocks have multiplied as the market priced in AI power demand. Bloom Energy makes solid oxide fuel cells. Think of these as portable, clean, on-site power plants that data centers can install in their parking lot, bypassing the grid entirely. This became Aschenbrenner's largest fund position. EQT Corporation is a major natural gas producer. As AI data centers come online, natural gas turbines are filling the gap until more nuclear and renewables come online. There are also small modular reactor companies and uranium miners benefiting from the same trend. Layer 2, Data Centers and Cooling. Equinix and Digital Realty are data center real estate giants. They own and operate the physical buildings. Vertiv Holdings is a less famous but critical name. They make the power management and cooling systems that keep data centers from melting down. Layer 3, Chips, the famous layer. Nvidia, the undisputed king of AI chips. Their GPUs train almost every major AI model. As of early 2026, Nvidia is the world's most valuable company, with a market cap around $4.5 to $4.8 trillion. The risk? Everyone already knows it is amazing. A huge amount of future success is already baked into the price. AMD is Nvidia's main competitor in AI accelerators. Smaller share but growing. Broadcom designs custom AI chips for Google, Meta, and reportedly Apple. They also dominate the networking silicon that connects GPUs together, often considered a more diversified bet than Nvidia. Taiwan Semiconductor, TSMC. Almost every advanced AI chip in the world is manufactured by TSMC. Nvidia designs, TSMC builds. A true pick and shovel play. Layer 4, Networking, Memory, Storage. Arista Networks and Cisco for high-speed switching between GPUs. Lumentum Holdings for optical transceivers, the lasers that move data inside data centers at terabit speeds. This was a new Aschenbrenner position. Micron and SanDisk for the high-bandwidth memory that AI chips depend on. Layer 5, Cloud and Compute Providers. Microsoft owns a big chunk of OpenAI, has integrated AI into Office, Windows, GitHub, and their Azure cloud business is one of the fastest-growing parts of the company. Often considered one of the lower volatility ways to own AI. Alphabet, Google's parent, owns Gemini, owns TPUs, their own AI chips, owns YouTube and Search, often trades at a cheaper valuation than peers. Amazon. AWS is the largest cloud provider in the world. Bedrock lets enterprises run any major AI model on AWS. You also get Amazon's retail and advertising business along for the ride. CoreWeave is the newer, pure-play AI cloud. They rent out GPU compute specifically for AI training and inference. Revenue roughly doubled in 2026. And the strangest category, former Bitcoin miners turned AI compute operators. Companies like Core Scientific, iRen, Cipher Mining, and Applied Digital already had the power contracts and the cooled buildings. Pivoting to AI workloads was a natural fit. Higher risk, but interesting exposure. Layer 6, Models and Applications. This is where you find Meta using AI to power ad targeting and content recommendations, and releasing the open-source Llama model. Meta's ad revenue grew by over 1/4 last year, largely thanks to AI. Palantir and ServiceNow are enterprise software companies layering AI into their existing platforms. And then there are the private AI labs, OpenAI, Anthropic, xAI, which you cannot directly buy as a retail investor, but you can get indirect exposure to through their backers. Microsoft owns part of OpenAI. Amazon and Google have invested in Anthropic. Now, important caveat. This is a long list. You do not need to know or own all of these. I am giving you the map so you understand what is out there. In a minute, we will talk about how to actually pick. Okay, so you know the players. Now the real question. Do you buy individual stocks or do you buy a basket of them through an ETF? Let me explain ETFs first, because this is where most beginners should probably start. An ETF, exchange traded fund, is basically a pre-made basket of stocks. You buy one share of the ETF, and you instantly own little pieces of dozens or hundreds of companies. It trades on the stock exchange just like a regular stock. The big advantage for beginners: diversification. If one company in the basket tanks, the others can offset it. You are not betting the farm on getting one stock pick right. Here are the main AI-focused ETFs to know. AIQ, Global X Artificial Intelligence and Technology ETF, broad exposure across the AI ecosystem. BOTZ, Global X Robotics and AI ETF, more focused on physical automation, robots, autonomous vehicles, industrial AI. Heavy international exposure, especially Japan. ARTY, iShares Future AI and Tech ETF, formerly known as IRBO. Equal weighted, which means it does not just dump everything into Nvidia. Lower fees than most. Chat, Roundhill Generative AI and Technology ETF, the most concentrated bet on generative AI specifically, more volatile. Now here is something most beginner videos do not tell you. If you already own a broad index fund, like an S&P 500 ETF or a Nasdaq 100 ETF like QQQ, you already own a lot of AI exposure. Nvidia, Microsoft, Apple, Alphabet, Amazon, Meta. They make up around 1/3 of the S&P 500. The five largest companies in the index now account for the highest concentration in over 50 years. So before you go buying a specialty AI ETF, check what you already own. You might be doubling up on the same names at a higher fee. When does it make sense to buy individual stocks instead? A few conditions. You are willing to do research on individual companies. You can stomach a single name dropping by 1/3 in a week without panic selling. And you have a clear thesis for why you are picking that specific company over the basket. For most beginners, my honest take is this: start with a broad market ETF or a single AI-focused ETF. Add individual stocks later, once you have sat through a real correction and know how you react. Now we have to talk about the elephant in the room. Is this an AI bubble? And the honest answer is, I do not know. Nobody does. But here is what the data actually shows in 2026. The bull case. The reasons this is not a bubble like the dot-com era. Big tech companies are funding their AI spending mostly from their own profits, not from debt. That is very different from 1999, when companies were burning through borrowed money. Companies like Microsoft, Google, Amazon, and Meta are projected to spend close to $700 billion on AI infrastructure in 2026, and they can afford it. Nvidia's profit margins are real. They posted gross margins above 70%. Those are not dot-com fantasy numbers. Those are some of the best margins in the entire economy, and the technology actually works. Hundreds of millions of people use AI tools every day. That was not true of most dot-com companies. The bear case, the reasons to be cautious. The Bank of England has formally warned about AI bubble risk. Major fund managers, around half in recent surveys, describe AI stocks as a bubble. Market concentration is at a 50-year high. The top 5 stocks in the S&P 500 account for around 1/3 of the entire index. If those few names stumble, it drags down everyone's retirement portfolio with them. The cyclically adjusted price-to-earnings ratio, a long-term valuation measure, is near levels last seen at the peak of the dot-com bubble, and there is a huge gap between AI spending and AI revenue. Companies are pouring hundreds of billions into infrastructure, but enterprise customers have not fully figured out how to monetize AI yet. If that gap does not close, expectations get reset hard. There is a famous comparison investors keep making. If you had bought Cisco at the peak of the dot-com bubble in 2000, Cisco being the Nvidia of that era, it took 18 years for the stock to break even. The internet was real. Cisco was a great company. The price was just wrong. My takeaway, and you should reach your own: AI is probably real. The valuations are probably stretched. Both things can be true at the same time. The question is not, is this a bubble? It is, how much am I willing to lose if I am wrong? Let me give you a simple framework. 5 rules. Write them down. Rule 1. Decide your AI allocation before you buy anything. A common guideline for thematic investments like AI is to keep them to between 5 and 15% of your total investment portfolio. The rest should be in broad, boring, diversified stuff: index funds, bonds, maybe some international exposure. AI is the spice, not the meal. Rule 2: dollar cost average. Do not lump sum into a hot theme. Instead of putting $5,000 in all at once, spread it out over 10 months. This way, if the market drops by 1/3 next quarter, you are buying more shares at lower prices instead of regretting your timing. This is especially important in volatile sectors like AI. Rule 3: know what you own and why. Before you buy any AI stock or ETF, you should be able to answer two questions in one sentence each. What does this company actually do? And why do I think it will be worth more in 5 years? If you cannot answer either one, do not buy it. Rule 4: pre-plan your reaction to a 30% drop. Here is a hard truth. Almost every AI stock will drop by around 1/3 at some point. Nvidia has done it, Meta has done it. Meta dropped by over 2/3 in 2022 before its huge recovery. The question is, when it happens to you, will you panic sell at the bottom or will you stay calm? The way to stay calm is to decide now, in writing, what you will do then. The worst time to make a decision is when you are losing money. Rule 5: separate your investing from your news consumption. AI news is constant, breathless, and designed to make you react. Most of it does not matter for a long-term investor. Pick a quarterly review schedule, say, the first weekend of every quarter, and only review your AI investments then. The rest of the time, leave them alone. Let me run through the mistakes I see beginners make, fast, so you can avoid them. Mistake 1: buying the most hyped stock at all-time highs. When CNBC has had AI on the front page for 6 weeks straight, that is usually not the best entry point. Mistake 2: concentrating everything into Nvidia. Yes, it has been the best performer. That does not mean it will be next year. Concentration risk is real. Mistake 3: buying penny stocks claiming to be AI companies. If a company has AI in its name and trades for under $1, it is almost certainly a scam or a desperate pivot. Stick to established, profitable businesses. Mistake 4: selling everything at the first drop. A 15% pullback in AI stocks is normal. A 30% drawdown is uncomfortable but historically common. Selling at the bottom is the most expensive mistake retail investors make. Mistake 5: ignoring fees. A 1% expense ratio does not sound like much. Over 3 decades, it can cost you hundreds of thousands of dollars in compounded returns. For ETFs, compare expense ratios carefully. Mistake 6: using leverage or options as a beginner. I see this constantly. Beginners buying leveraged AI ETFs or short-term options on Nvidia. Do not. You will lose money. Master the basics with regular stocks first. All right, if you have watched this far and you want to actually start, here is the practical checklist. Step 1: open a brokerage account if you do not already have one. In the US, that means somewhere like Fidelity, Schwab, or Vanguard. Outside the US, look for low-fee brokers in your region. Avoid platforms that gamify trading. You are investing, not playing a slot machine. Step 2: build your foundation first. Before you buy any AI-specific investment, make sure you have a broad market index fund as your core holding, something like an S&P 500 ETF or a total world stock ETF. Step 3: decide your AI allocation. Be specific. Write down what percentage of your portfolio you are allocating to AI investments. Step 4: choose your vehicle. ETF for diversification, individual stocks if you have a clear thesis. For most beginners, I would start with one broad AI ETF, something like AIQ or ARTY, and maybe one individual stock you understand deeply. Step 5: set up automatic monthly contributions. Do not try to time the market. Just buy a small amount on the same day every month. Step 6: write down your plan and your exit conditions. What would make you sell? What would make you buy more? Having this written down in advance is the single biggest thing separating disciplined investors from emotional ones. Here is the truth most finance videos will not say out loud. Nobody can tell you whether AI stocks will double from here or get cut in half.
Anyone claiming certainty is either selling something or lying to themselves. What I can tell you is that the investors who do best are not the ones who picked the perfect stock. They are the ones who built a sensible plan, stuck to it through the panics and the manias, and let compounding do the work over decades. AI is going to change a lot. It might be the biggest investment theme of our lifetime, or it might be 1999 all over again, probably some of both. Your job is not to predict which. It is to position yourself so you benefit if it works and survive if it does not. If this helped, subscribe for more. Drop a comment with what AI stock or ETF you are considering. This is not financial advice. I am not a financial advisor. Do your own research. Talk to a real advisor for big decisions and invest in the index funds your future self will thank you for.